your time and your attention. So thank you for joining us today for Bad Days Are Only Temporary, a 2022 market update. In today's webinar, we'll talk about the fact that negativity is everywhere. It is difficult staying positive when everything is negative. Throughout the webinar, please add any questions into the chat section. We've allowed time at the end for questions. Also, if you'd like to learn more about 360 Financial and the services we provide to our clients, stick around at the end of the webinar for a few more minutes. Now I'll turn it over to Mike Rogers, President and founder of 360 Financial. Prior to establishing the firm in 1995, he spent 7 years building a solid financial base with two of the nation's largest investment firms. As a fiduciary, he utilizes his 30+ years of experience to orchestrate and implement customized strategies, specifically tailored to address the issues and concerns of qualified retirement plan trustees, high-level professionals, and thriving business owners. Take it away, Mike.
Thank you, Troni. Thanks everybody for joining. We have a great turnout for today's webinar. This is not a long webinar. We've done other ones in the past that go for about an hour. We've done on different topics, whether those are topics around residency and if you're going to change residency or updates for the year. We are going to do another program in about 2 weeks. That'll be a little bit more data driven and a little bit longer in duration. So this one is really just a response to what we're seeing from our clients that are asking questions. And so the June statements have shown up. They don't look good, and we know that that's a scenario that we wanted to address with all of our clients. And we thought by putting together about a 15 to 30 minute, depending on Q&A program, that kind of gives you an idea of our thoughts and our thought leadership and where we're at with our strategies, I thought would be really helpful. So hence the program. So I'm going to screen share and we will start the program, which we have titled, as Troni said, Bad Days Are Only Temporary. And I think this is not only a very good motivational adage to always keep in mind when we're facing bad days, but especially when we have a scenario like we do right now, where the news and the markets are negative, and so specifically, this is what we're facing. All around us is negativity, it seems like. At least it seems like to me. And I had a client in here earlier. They said, you know what? We don't even bother turning on the TV. And these are just headlines from different papers around the world. Talks about the stock market slide, sell, 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 markets in turmoil. Recently we've been hearing a lot of talk that the first 6 months of 2022 have been the worst time in the beginning of the year returns, in the first 2 quarters of the year returns, I should say, since 1970. So that's 52 years ago, we had as bad a first half as we've had this half that we've just come off of. What's interesting, when I have been talking with clients and I asked a question, okay, let's say back in 1970, the first half of the year was a negative 20%, just like it has been this half of the year. What do you think that the S&P 500 ended down for the year? And most people I couldn't even guess, 30%, 40% down, they kind of just double in their math up in their head that, must have been just as bad in the second half. So the hope that we bring to this conversation today is the stock market, as measured by the S&P 500, was actually up 4% for the year of 1970, not including dividends. Included dividends, it was up about 6%. So there is hope. And this negativity that's all around us pulls us down. That's my mom used to call them negative Nancy's, and they always have something negative to say. But you know what? There's been lots of positives that have gone on. COVID situation, extremely different than it was 2 years ago at this time. Death rates are way down. People are vaccinated. They're getting boosters when they do catch COVID. Hopefully for most people, it's nothing more than a cold type of symptom environment. Not for everybody I know, but COVID is is less of an issue. The consumer is in good standing right now. They have some money in the bank and they have been spending. The reason we have inflation is they spend it on goods and things and appliances and lumber and sheetrock and paint instead of services and experiences, because during COVID we were not able to have those services and experiences. So the point is, not everything is negative. But if you look at the recent University of Michigan Consumer Sentiment Index, you would think they've all jumped into the negativity pool together. And what this is showing you, and let's see if I can pull up a little, highlighter for you. Yeah, that's okay. We'll just kind of go through it. It was pulling up here on my screen earlier, but what this is showing is consumer index going back to 1971. So University of Michigan has been doing this, and every quarter they track how's the consumer feeling. What are their thoughts? And a lot of times these consumers also happen to be small business owners, not necessarily inclusive to only small business owners, exclusive, I should say, to small business owners, but gives an idea of where does the consumer feel that the world is right now. And so when you have a scenario where it's dropping, and for example, if you go to the left side of the chart, 1973 to 1974, consumer confidence bottomed out in 1975. Okay. And what this basically is saying is 12 months later, if you look at this right in here, now I'm going to get a highlighter so if I look right here, that's where I'm at. Okay. Consumer confidence bottomed out in 1975. The stock market 12 months later was up 22%. Okay. The consumer confidence bottomed out again in 1980. Stock market 12 months later was up 20%. Okay. And you'll see the same thing happen here. 1990, 2003, 2005. Every time we have this trough, if you will, in consumer confidence, 1 year later, the stock market has had some pretty substantial rebounds. And again, I got to surface everything as we are looking at historical data. We don't know exactly where the bottom of this market is going to be, but we do know that all bad markets, just like all bad days, are temporary, and bad markets turn into good markets. And the key to investing and staying with your investment process and philosophy and discipline is to not get spooked out of the market when everybody else is negative and the consumer sentiment is tanked down to low levels. As a matter of fact, look right now. June rating, the lowest it's ever been since the University of Michigan has been tracking consumer sentiment. Okay. Even when we hit COVID, consumer sentiment did not drop as much. Part of it was because of all the Federal Reserve money stimulation and the government putting in different programs. Stock market bounced up quite a bit. Okay, but this consumer confidence and sentiment has driven down to a level where if you're a little bit contrarian, and this is what I want you to look at, it's actually a positive sign. What it's saying is that when everybody is fearful, that's when the stock markets tend to do the best. And so if you look at 8 troughs historically since University of Michigan's been putting together this data, 1 year later, the returns on the S&P 500 have been almost 25%. Conversely, when everybody is partying like it's the roaring 20s, and they think that this time is different, we're not going to have bad times in the future. Actually, what's interesting is at the peaks, the S&P 500 1 year later is only up 4.1%. So I want you to look at this and say, okay, consumer sentiment is bad. Negativity is out there. Lots of people are very, very negative on all kinds of different topics. We're taking an approach that we're cautiously optimistic that things are going to get better. And we don't know the bottom of this market. But when we start looking at charts like this, it's telling us that we have some reason to be optimistic. Let me go to the next page, which also kind of puts into his perspective. And this is only a few pages long, this program. It's about 5 or 6 slides, actually. So I've been in this industry now for 30 years. And in 1990, I started with Payne Weber, a Wall Street firm here in town. And back then, we were looking at the overall markets and trying to do some sort of financial planning. Now over the years, we've developed into a full-blown wealth management firm that uses investment strategies to drive what we call our LifeWealth process. Okay, it's not a commercial, but it just kind of shows the evolution of the industry. But one thing I know for sure over the 30 years is I've had 7 or 8, maybe 9 times where the negativity became so bad that everybody literally thought this time was different. And I use it here on the top of the slide. The world's coming to an end. Okay. Well, thankfully, 30 years later in this industry, the world has not come to an end. And we had a scenario where, for the most part, these market drops that we experience on any one given year usually end up reversing themselves. So what this chart is showing you, lots of data points here, but it's basically going back to 1980. So not quite as far back as the other chart with the consumer sentiment information. And these red dots, I'm trying to track along. Here's one way down. Here's another one way down. These are the rate of returns at any one given year or one given point of the year. So the negative returns specifically. So at one time, for example, let's go back to 1980. Stock market was down 17% during the year. And you can see there's almost always red dots. There's been actually in recent history very little red dots, and that's kind of why we forgot a little bit about market volatility. If you had joined us for our Outlook 2022, why we did not predict a 20 or 30% drop in the stock market, we did talk about valuations being a little bit high, and we talked about expect a drop in the market sometime during the year. We didn't know it was going to start about 2 weeks after that program, but it's typical that we get anywhere from a 10 to 15% drop in the stock market. The S&P 500 is in bear market territory. Negative 20% is what marks that. So now let's look at the positive here. What this is showing you is up on the top line. It's showing you what did the S&P 500 returns end up at year end. Okay, so in other words, were they positive or were they negative? Well, despite drops of 14% on average, over the last 42 years, 32 of them actually ended up positive. Again, will that happen in 2022? To be determined. On a very, very, very short duration model, at least the first week of the year was positive. The S&P 500 had a nice gain for the first week of July, and then yesterday we gave some of it back, and today we're about flat. Okay, so being down 20% is not uncommon. Being down 20% for the whole year is actually fairly uncommon, but it happens about a quarter of the time if you look at the historical graphs going back 42 years. Okay, so that gives us a little reason for hope. Okay, how about when we look at kind of longer time periods? I know some of you on the call are retired, and so you're concerned about, okay, is my lifestyle going to change because of the market drop? Okay, talk to your advisor. Make sure that we're running new projections for you. In most cases that we found, in almost every single one, frankly, lifestyle changes are not occurring for clients. And the big reason is if we go back to last year's big returns, we have not really changed that much, if you will, as far as the projections going out further. So what this chart is showing you is longer time periods compared to shorter time periods. So what we have down here is what are the rate of returns of stocks, bonds, and a blended portfolio between 50% stocks and 50% bonds. Okay, and that's 1 year. And then we run this all out and we go out over a 20-year rolling period. 20 years is especially important for anybody who's on the webinar that's in their 40s, and they're worried or a little bit overwhelmed about what's been going on in the world and how this impacts their investments. Okay, but could also be somebody in their 50s like I am, because God willing, the one day when I do retire, let's say typical age of 65, I decide to retire at 66 or 67, whatever the number that is. I hope that I'll live another 10 or 15 or 20 years in those retirement phases. Okay, so this 20-year rolling period is really appropriate for probably a lot of people on the webinar. But let's go back to the 1-year number. And what this shows is the range of stock returns are anywhere from as low as 39% as a high of 47%. Okay. Now, bonds tend to be less volatile. This year, bonds have been a little bit problematic, and that's why when we look at rate of returns for this year, as interest rates have spiked up, bond prices have dropped. Okay, so we do get historically time periods going all the way back to 1950 where bonds are negative, just like they are this year. And they usually range anywhere from a negative 8% down here all the way up to a positive 43%. Okay, right now we're experiencing that negative 8%. Okay, and the mix of those two investment classes generates a positive rate of return historically of 33% over one given year and a negative 15% over one given year. Okay. Look what happens to these ranges as they get further and further out. They get smaller and smaller. And so what we have is literally over time, a lot of the volatility of the short-term reactions to the stock market go away. Okay. Now, here's how I like to compare it to stock market returns and stock market prices. They go up and down every single day. I think what this chart shows you is if we're buying investments that own good quality stocks that pay dividends, and that's predominantly a lot of our clients' holdings. It might be in an ETF, might be in a mutual fund, but if we own good quality companies, what we got to keep focused on are the long-term perspective of these companies. Do we really think companies like Microsoft, Merck, Johnson & Johnson, you can name all kinds of individual companies, do you think that those companies are worth, 20 or 30% less than they were a year ago? What we have is short-term stock price movements that create this volatility. Over longer time periods, what we hope for is that the value of those companies' performance, the value of their earnings going up over time takes out some of that volatility. So here's just a nice way of looking at it over a very long time horizon. Stocks have generated an 11.5% return over the last 20 years. Bonds 5.8. And if we blend the portfolio to try to keep some of the risk in check and manage that, you're looking at a 9% return. Another way of looking at it, $100,000 20 years ago would be worth almost $900,000 in the stock market, $300,000 in the bond market, and almost $600,000 in the mixed portfolio. So yes, these 1 years, and I don't want to minimize it, are scary. The volatility is scary. And we're, hopefully looking at a scenario where we're somewhere near, a bottom. But again, we don't know exactly where that might end up. So let's look at some really long-term data points to give us some idea of what happens when a bear market starts, and then what happens when a bear market ends. So we have 13 different times and reference points here. Okay, and what we're trying to track for you, going back all the way to the Depression, is the returns of the S&P 500. The gray areas, if you see this gray bar here, that's recession time periods. Okay, and then what we're showing up above in these diamonds correlate to the characteristics of bull and bear market events in history. Okay, so we have the crash of 1929 here. I mean, that's obviously a big drop as far as number one. We also had a Fed tightening policy back in 1937. That's in here. But let's look at a little bit more modern times. Maybe even I don't know. Let's go right here. We'll take it to about 1958, 1960. And so what you have in there a little bit more modern times is things like a financial crisis. We had one of those in 2008 as well, didn't we? We don't seem to have one now going on, but we do have one that we can reference in more recent history, which is right in here. Okay. So what's the point of this? All these time horizons, on average, the worst case stock market returns of negative 86%. Average out of all those 13 data points, negative 42%. And that bear market lasted for 22 months on average. During COVID, we had 1 month of a bear market. Okay. And we've had as long as 60 months or 5 years. So you're going from a 1 year to a 1 month to a 5-year duration, those bear markets. And you can see here what these macro environments showing is, okay, there was a recession going on in most of these years. Commodity spikes. In other words, we had inflation going on in those years. We had an aggressive Federal Reserve pushing up interest rates in a lot of those years, and extreme valuations going into those time periods. This said the stocks maybe were overvalued if you look at historically what they should be priced at in about half of those years. Okay. So all kinds of scenarios like we have right now. Okay. And then when we get into the bull market scenario, let's say, when does the bear market end? Well, it lasted, 1 month back in COVID time periods, and then it started back up as far as, kind of rate of returns are concerned. So bull market returns are 166% gains and last almost, 5 years in duration. So bear markets tend to last about 2 years in duration. Bull markets tend to last about 5 years in duration. It looks historically, I don't know this for sure, but more recent bear markets tend to be shorter in duration. Not all the time, but tend to be shorter in duration. And the bull markets have been tending to be longer in duration than the averages. So again, we look at that as being a positive for where we're at right now. And I think when we look at history, and I've had a few people say to me, Mike, there's never been a time like this one, And I said to the few people, I said, yeah, there has. And you can pull up this chart and you can see there's been lots of times where we've had recession and we've had inflation and we've had interest rates going up. And what I tell people is, if you look at historically longer time periods, as long as you have a strategy and a portfolio that makes sense for you, let's focus on what we can control. And we know we can't control what the stock market is going to do. What we can control is how do we look at what our goals are, what is our projections for meeting those goals, what is the potential rate of return going forward from today as we move forward into the future, as we run those new projections, and are still on track. Okay. For the people who are still working, I also would look at, the fact that you contribute to your 401k plan every pay period. Dollar cost averaging is an effective strategy. And remember, here at 360, we do have a process in place. We call it our foundational leadership process, where we're investing in good quality companies through exchange traded funds and mutual funds. Typically, we're not buying individual stocks, and then we're looking for where is there strength in the overall markets. Okay, so we do have a discipline. We do have a strategy. It's worked very well for us in the past. It's been struggling this year, just like everything has been struggling this year. And we're hopeful and looking forward to the days where the returns start showing, the results that we're more accustomed to. But right now, it's a difficult time. And what I need to address for all of us is, we know we can't control the stock market, whether it was fantastic like last year, or it's in a scenario like this year where it's negative. So let's control what we can. That means talk to your advisor about tax strategies in a bad market. What do you do to try to make some lemonade out of these lemons? update some projections if you're feeling uncomfortable as far as what goals you're going to hit, and if there's any things that you need to change. Look at, and again, talk to your advisor about these things, but look at potentially doing some Roth type of conversions. Again, it really depends on your income and where that's at. But if your Roth account has dropped a lot in value and you move that over to if your traditional IRAs lost a lot in value and you move it to a Roth, maybe it's a good time to do that because it's a lower valuation on that traditional IRA account, and gives the ability for this rebound to happen in a tax-free Roth environment. But don't do that, on a whim. Look at the pros and the cons of doing that and making sure that it doesn't drive up your income, because the conversion is a taxable event, to the point where maybe you're paying more in Medicare tax, Medicare cost, or you pay more in taxes in general, or you lose the ability of a low tax bracket on capital gains, for example. So again, lots of things that we can control. And what I always like to talk to people about controlling is 4 aspects. And most of you, I know, have heard this all the time, but in this LifeWealth plan process that we talk about is, let's control our goals around family, our goals around our occupation, whether you're retired or not. What does that look like as far as your work, your purpose when you get up in the morning? Let's control our goals around recreation, the fun stuff, the actual impactful events. Maybe it's traveling, like a client just told me recently, for their 50th anniversary to Hawaii as a family. That's a recreational event and a family event combined into one. And then we can control the money aspect. So family, occupation, recreation, and money. Form. And if we focus on form, we'll get through these bad times together. We will have sunny days, and it's a beautiful day here in Minnesota. We're going to expect that we're going to get back to that in the market as well. So thank you for joining me for this program that went a little bit longer, but I got excited about it, and hopefully that came across in the content. So Troni, it's up to you to let me know what questions came in.
Yes, thank you for your time today. We will be emailing out the webinar, so all this content will be available after the fact. And if you can stay on, I know we have a 1:30 stop and 1 minute left, but we do have 3 different questions in the queue here. One question is, what causes overvaluation in companies in the stock market?
Okay, that's a great question. That first slide that I showed that talks about, kind of that consumer sentiment, and a lot of times that drives not only valuations as well as stock market returns. So what I mean by that is companies and individuals will buy stocks and bid up the prices. We're kind of seeing it now in the housing market, with the supply and demand imbalance that we have in housing. But one reason that stocks get overvalued is because we simply just have more buyers showing up that are exuberant or overzealous to buy a stock at kind of any price. And when you have an environment like that, the price keeps inching up to the point where, and we had this in a big way back in 1999, when now I'm showing my age, but 1999, when the dot-com stocks went up and up and up and up. More recent example might be that speculative thing called Bitcoin that went up to $60,000 a share, now is at $20,000 a share. But speculation drives up a lot of times valuations. And sometimes what ends up happening is those valuations get too high, and the market does really a healthy, while it's painful for us, it's kind of a healthy reset of a lot of those stocks. And brings them back down. Right now, I will tell you that overall, the S&P 500 earnings are slightly below average as far as valuations. Not cheap like we had back in 08, but with this market drop, they are slightly below valuations. So hopefully that answers the question.
Great. We have another question. How does the oil crisis affect the market? Truckers can't afford the diesel. Trucks are sitting idle at truck stops. Drivers are dropping out of the industry.
There's a lot in there. drivers are dropping out of the industry, and a lot of people have been dropping out of different industries. Ask anybody who owns a manufacturing company, home building company, the trades especially have been hurting. I don't know if I have an answer for that one, except for maybe more young people will see the benefit of the trades, especially as the salaries and the benefits have increased. The oil prices do, frankly, they act as a tax on the consumers and on certain sectors of the economy, like trucking. And so when you have $5 fuel prices or higher, that is a very difficult environment for the transportation companies in particular. It also stretches into the airline stocks, and other areas that are reliant on that oil production. What's interesting, and we'll see if this is a long-term trend. Inflation ran at about 8.6% last month, which is a very, very high number. That's our wild card in a lot of things right now. And the number one factor of that high inflation number was energy cost. And so if we can get energy costs to subside a little bit, and oil today, I think, is about $103 a barrel. It was up to about $120 a barrel. We're seeing a slight decrease at the pump. Hopefully that gives some reprieve to some of these industries that have really been hit hard by that tax, if you will, of higher prices for running their business. And that's a driver of inflation. It's difficult for the transportation companies in this sort of marketplace just because of that variable cost going up and the lack of workers that they can find. And maybe technology will solve some of that problem. In the long term, self-driving trucks, but in the short term, a little reprieve on oil prices sure would be helpful.
Two more questions. A recent NPR broadcast said there should be a new definition of a recession, not just 2 consecutive quarters. Their point was that if we end up having 2 consecutive bad quarters this year, excuse me, it might not actually be a recession, maybe due to the employment rate. Your comments?
Yeah, it's a good question. The one thing about data points is when they become irrelevant to us is when we change the formulas to all the data points. So sometimes I hear, should the CPI number be revised? Is inflation as a CPI gauge an inaccurate look of inflation? Or is unemployment not tracked really as well or as specifically as it should? So with the recession definition, I say, it's kind of what we have. There are other sources out there that look at recession differently than 2 quarters of negative GDP growth, which I know is an oxymoron, but basically meaning the economy is shrinking. And I think maybe the question is referencing last quarter, we had negative GDP in the US economy. And it was basically a reflection of import-export imbalances. And that drove a negative GDP. The consumer confidence was still high as far as spending was concerned. We saw earlier the sentiment was starting to drop at the beginning of the year, but the spending was still high. And there's a lot of economic activity that was real positive, but GDP was negative for that first quarter. And maybe it will be negative for the second quarter as well. But it seems like a lot of these imbalances on the trade front have somewhat loosened up a little bit, despite still having supply chain issues. So I didn't see the NPR article or report that they have generated, but there's been a lot of talk about, is 2 quarters really a good gauge of a drop in the economy or not? And right now, it's kind of the most prevalent gauge. And so we continue to use it, whether it's flawed or not flawed.
And the last question we have, what if this time is different, like in 1933? When do you decide the bear market is over?
Yeah, that's a good question. Even in 1933, the markets did come back. It took a long time for that to happen. The economy is drastically different than it was in 1933. Just think about that versus where we're at, about 100 years later, as far as what drives the economy. For the most part, service type of economy, higher technology, companies make earnings. If this time is not different, then everything we just talked about is going to have a hard time materializing. But we we do feel that we've seen a lot of the environment that we're in right now. The 2008 and 2009 scenario was drastically different than what we have now. Back then, we had banks failing, Merrill Lynch having to get, basically bought out and rescued by, Bank of America, brokered through the government. All the big automobile companies bankrupt in the United States, having to get bailed out. Right now we're fighting high inflation, and the Federal Reserve is raising interest rates pretty rapidly to try to get that under control. The other thing that will get that under control is maybe a shift in people's spending habits. Remember, during COVID, they were spending money on goods, on things. They were buying new appliances and sheetrock and paint and lumber, and that drove and spiked up the demand and drove up the prices of those goods. Typically we're buying services, then we're buying experiences. Then we'll probably get back to that eventually. But as of right now, we're seeing more of this mix. So we don't think this is going to be a 1933 market. If it is, and this time is not different, it's going to take longer for everything to materialize than what we're hoping for in this 30-minute presentation.
Great. Well, this will conclude the program. Mike, I might ask you to pull up the disclaimer language. And everybody that's still on the webinar, if you have any questions, please feel free to follow up with anybody at 360 or contact Mike himself or your own advisor. We thank you for your time. Please reach out if you have any further questions.
Yeah, thank you, everybody. Have a great day.